Welcome back. So cues across Asia are thin. Two major markets, Hong Kong and Japan, are trading, and they've been trading with a fair amount of caution. We, of course, are expecting a bit of a recovery maybe after the slam dunk yesterday. So the implied open is suggesting at least a positive start for what it's worth. Ned, let's now talk about the whole raft of earnings and news flow that we were dealing with after market hours yesterday. We have our team standing by with the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. Nigel, let's start with the big boy first. Tata Steel. I mean, first glance, the numbers look okay, but what's the fine print? What do you think?
Well, the first glance, the numbers look blockbuster, but that wasn't the case. There are a couple of adjustments, but yet the numbers are better than what the street was working with. So the revenue number was a little bit better. The EBITDA number that you saw, well, that looked much better, but the EBITDA number included a reversal of an older provision, which was to the tune of around 1,400 crores. So stripped of that as well, the consolidated EBITDA number is more or less in line with what we were working with. Now, for Tata Steel, you look at two crucial numbers. One is the standalone, the India EBITDA per ton, which is a little bit better than what the street was working with by around 300 rupees or thereabouts, because the fall in realizations wasn't as much as what the management had guided earlier, and they've got the benefit, obviously, of lower input costs as well. So India was a little bit better, and the European business losses were less than expected. So that's good news. How did they manage that? Because the Netherlands business slipped into the red. Steel prices out there were very, very weak, so that was the issue out there. However, the UK business losses, that halved. Why is that? Because they've shut down their furnaces, so the fixed cost came down drastically. The net debt number as well did come down by close to around 3,000 crores because of release of working capital. So put everything together, the operational performance, better performance coming in from India, European losses a little bit lower, and the net debt coming in lower. I'm going with green on this one. The stock should react positively to this set of numbers.
Okay, so Tata Steel looking good. What about Coal India, Nigel?
Well, Coal India as well, I'm going with green on this one, because remember, Coal India, they've changed the way they account for various items, but going with green out there. Let me give you the rationale. The top line, well, that was a little bit better than what we were working with, very little better, but that was good. The EBITDA number as well, a little bit better, and the profit number a little bit better out there. How did they manage this? The employee cost was down by close to around 3%, and the stripping activity credit, which is effectively an accounting entry, out there the credit was close to around 1,900 crores. Most on the street were factoring in 1,000 to around 1,200 crores. So because of both those two, yeah, the operational performance was better. The overall realizations, well, they came in high. That's a blended realization was up by close to around 3% on a sequential basis. But if you split it up for our viewers, between FSA as well as e-auction, FSA realizations, just take a look at that. That's improved by close to around 4% because the grade mix was better. So that's what's helped the blended realizations to come in better. And e-auctions as well on a sequential basis, that's seen a recovery of around 200 rupees per ton. So good realizations, better than expected realizations. The e-auction premium has moved up now to around 76% from around 69% in the previous quarter. And also they've declared close to around 5 rupees of dividends. So give and take everything. Going with green on this one, it has valuation comfort as well. So Coal India should react positively.
Okay, all right. That is Coal India. So thumbs up for both Tata Steel and Coal India. Let's move on. Some BFSI numbers now. Abhishek, you're watching out for Bajaj Housing Finance as well as Piramal Enterprises?
Well, Bajaj Housing Finance, it was a good quarter for them with respect to the AUM growth that they have had. It's up 26% YOY and about 5.5% sequentially. The disbursements growth was strong, around 4.5% sequentially. That's aided the AUM growth this time around. Net interest income is up almost 25% YOY and about 13% sequentially. The PAT is up 25.5% YOY and about 0.4% sequentially, largely impacted by the provisioning, which has shot up multifold times on a sequential and YOY basis. The net interest margin has come in at 4% versus 4.1% in the previous quarter. Asset quality largely stable at 0.29% gross NP ratio. Piramal Finance, the disbursements and AUM growth are in single digits. So disbursements are up 8.7% YOY and AUM is up about 9.6% YOY. That's on the weaker side. On the good side, the net interest margin has expanded 5.7% versus 4.9% in the same quarter last year and about 5.1% in the previous quarter. Even their asset quality has improved, so gross NPA ratio is down to 2.83% versus 3.1% in the previous quarter. Back to you.
All right, Abhishek, thank you very much for that. So that's Piramal Enterprises in focus. IGL is the next one we're going to turn our attention to. Sudarshan is here with more. So good morning.
Morning, Prashant. So IGL earnings are looking better than estimates, mainly led by volumes, which saw an increase both on sequential and year-on-year basis. Even on the guidance front, 9-month FY25 earnings are looking in line with the guidance that company has given for FY25. Talking about the operating numbers, EBITDA has come in at rupees 364 crore, which is 24% higher than our estimate. Even margin is coming at 9.7%, which is almost 200 basis points our estimate of 7.8%. Now, talking about the one important tracking point, that is EBITDA per SCM, which is coming at rupees 4.34. That is also 22% higher than our estimate of rupees 3.60. So overall, on the earnings are good, given by IGL for Q3. Now, conference earnings call is at 4 p.m. today. 2 points that will be in the focus. First, what is company's plan on the pricing front? And second, if company has heard anything from the government side on APM gas allocation.
Okay, all right. Thanks a lot for that, Sudarshan. Well, let's hop across to Abhishek. He's here to tell us about Federal Bank and Union Bank. Abhishek, take it away.
Well, both of them had a similarity, that is weak business momentum. For Federal Bank, the business momentum on a sequential basis is one of the worst that you are seeing in last 14 quarters. Deposits are down 1% sequentially. Advances are almost flat on a sequential basis. The net interest margin has come in at 18-quarter low of 3.11% versus 3.12% in the previous quarter. The credit deposit ratio is at 28-quarter high of 86.5% versus 85.5% sequentially. The asset quality continues to remain robust for most of the financial entities. So gross NPA ratio is one of the lowest that you are seeing in last 9 to 10 years at 1.95% versus 2.1% in the previous quarter. Provisions are elevated at about 292 crores this time around, up 84.5% sequentially. We need to understand from the management what caused the spike in these provisions. Union Bank of India deposit growth at just 3.8% YOY, one of the lowest in last 13 quarters. Advances, it is down 2% quarter-on-quarter, one of the lowest that you are seeing in last 10 quarters. Advances growth are at just 2.7% YOY, one of the lowest in last 12 quarters. Slippages have declined massively. They had a one-off in the previous quarter. Asset quality, 10-year low, gross NPA ratio at 3.85%. Weak underwriting standards because write-offs continue to remain higher than slippages this time around. Operating profits are down more than 7.5% quarter-on-quarter, and that is why the PAT is down 2.5% quarter-on-quarter. Back to you.
Okay, all right. Got it, Abhishek. Thanks for that. We will, of course, connect with the management of Federal Bank. They are joining us at around 9:50. So we'll talk about some of those issues. The business momentum that Abhishek is saying has been weak in the third quarter. Moving on then, we have, the spotlight on 360 ONE WAM because of not just the business performance, but the fact that they've bought one of India's oldest brokers, BNK. Vamakshi, morning. Tell us more.
Well, absolutely, Surabhi. Let me first start off with the numbers. ARR, that is the annual recurring revenue, is seeing an uptick of 7% sequentially, more or less in line with what the street was anticipating. The transaction and brokerage income, on the other hand, has seen a dip of 6%, but this is much better than what the street was anticipating. And overall, the revenue is seeing a growth of 3% sequentially, slightly better than what the street was expecting. When we look at the cost-to-income ratio, that has shot up by 196 basis points sequentially, and this is led by higher employee costs as well as admin and other expenses. Resultantly, operating profit has dipped 1%, but the net profit is up nearly 12% sequentially, and this uptick is largely being driven by the sharp jump that we're seeing in the other income. Apart from that, more importantly, the company has announced the acquisition of BNK Securities India Private Limited and Batliwala and Karani FinServ Private Limited. The total consideration for BNK Securities is at 1,774 crores, which is a mix of cash as well as proposed preference issue, while for Batliwala and Karani FinServ, it is at 109 crores. So total, somewhere around 1,884 crores is where the acquisition is at a price to, for BNK Securities, the price to sales comes at 12.3, while for Batliwala and Karani FinServ, it comes at 8.1. So overall, a good set of numbers. The acquisition coming through bodes well for the company.
All right, Vamakshi, thank you very much for that. Imami reported numbers as well. Mangalam is here with details. Mangalam, morning.
Good morning. So it's a better set than peers, when it comes to Imami's third quarter numbers. Why do I say that? Because the sector is parched for growth. In that, Imami has done 5.3% revenue growth. And at a time when most companies are reporting margin contraction, Imami's gone ahead and reported EBITDA growth of 7.6%. Yes, the margins have improved by about 70 basis points, but they've improved as against contractions reported by peers. And the net profit has increased by 7% as well. It gets better because the core domestic business has actually grown by about 9%. With an underlying volume growth of 6%. So that's something that, most companies report when the going is good, and Imami's done that in tough period as well. At the same time, the winter products, where a lot of companies called out seasonality, impact, delayed winter on their winter portfolio. Look at Imami's winter portfolio. Boro Plus grew by about 20%, healthcare grew by about 13% as well. So these numbers, in light of the environment in the consumption sector, along with the valuations at which Imami trades at, stand out as brilliant. So expect the stock to see green today.
I completely concur with that. They do look brilliant when you have large companies reporting flat growth, no growth, or, those anemic 1-2% kind of numbers. Not bad. Let's see how Imami does. Mangalam, thank you for that. And now let's come to the big one. Kaynes Technologies. The reason we're calling this big is that it's a mixed bag. The growth has slowed down, though there is margin expansion. Upasna, EMS space always hot. Tell us more about Kaynes.
Well, good morning. The numbers have missed the earnings expectations. Now revenue PAT below estimates, while EBITDA margin is largely in line. Now let's talk about the revenue growth first. Now revenue growth has slowed down in Q3 FY25. Revenue growth stood at just 30% versus the expectation of 55% to 60% on a year-on-year basis. Now there's a sharp rise in employee expenses and other expenses leading to overall PAT miss. Order book stood at 6,047 crore with an uptick of 59% on a YoY basis, which was much strong as anticipated. Now looking at 9-month FY25 revenue, it stands at 1,737 crore with an uptick of 50% on a YoY basis. While with this number, it is difficult for the company to meet its FY25 guidance of 3,000 crores. Now coming to the numbers, revenue saw an uptick of 30%. Which was much below our expectations. EBITDA stood at 94 crores with an uptick of 34%. EBITDA margins expanded by 50 basis points at 14.2%. And lastly, PAT stood at 66 crores with an uptick of 47% on a YoY basis below our estimates. So all in all, numbers are a miss.
Okay, all right. Thanks a lot for that, Upasna. Let's hop across to Manisha. She's here to tell us about the commodity markets. Manisha, take it away.
Well, thank you for that, Nigel. I'll start with the crude oil prices, which have seen a constant decline, another 2% of a fall in the overnight markets. And with this, the WTI is now trading at a 1-month lows and the Brent crude price is at a 2-week lows. We are facing the weak China economic demand, U.S. tariff uncertainties, also the U.S. sanctions on Russia, and now Saudi Arabia is signaling intentions to raise oil prices for Asia. And not just crude oil prices, which have been declining. It's a similar state for the metal prices also, where overnight, because of the weak Chinese data, we have seen copper prices decline by 2%. Aluminum is trading at a 2-week lows. Nickel prices at a 4-year lows as well. Same is the case with the precious metal prices, where gold is off its 2-month highs now, and we've seen a percentage point decline on both gold and silver markets. Well, we have seen money flow into favored fixed income and defensive equities, but markets feel that Fed will deliver 2 rate cuts in 2025, and that in turn could be supportive. But overnight markets, clearly, everything is in a decline.
Okay, all right. Thanks a lot for that, Manisha. Well, we'll slip into a short break. On the other side, we'll focus on Kaynes Technologies. Stay with us.